Good afternoon, everybody. Welcome back to the Schwab YouTube coaching channel known as Trader Talks. I'm your host, Kevin Horner, today for Trading Price Patterns. I want to thank you all for joining me as we wrap up this brief window of my taking over and kind of substituting here for our friend Barb Armstrong. This is our final time together, at least over this window. Barb will be returning next week. I know many of you are excited to see her back. We are obviously pleased to be getting her back into the fold next week with all of us as well. So today we are going to look at a couple of new opportunities, new example trades that is, and we're going to consider one or two bullish scenarios and a couple of bearish scenarios. And then, of course, take a peek at the example portfolio. We had a couple of example trades placed last week that we want to look at and address and see if we need to make some alterations or maybe close some of our positions. So we'll take a look at that as well. Today, we're joined by Brent Moores there in the chat. Say hey to Brent. He and I had a really nice conversation this morning as we kicked off the market day in Trader Talk in today's market. That's our consistent schedule. Brent and I moving together on Wednesdays. We have a wonderful time doing that. And if you, excuse me, if you missed it, it has been approved, reviewed, and placed into the archive. So make sure you're checking that out on the channel. Additionally, if you haven't already done so, you can follow Brent and me on X, Brent Moores CS, Kevin Horner CS. We do try to post for you there throughout the week. Today, as a member of the team, I was responsible for our video, so we have an X video on the on my profile today, looking at an individual stock that's a bullish bias within a bullish bias sector. So if that's of note to you, check that one out for me and make sure you're following us there on X. And then lastly, of course, make sure you are subscribed to the YouTube coaching channel here, everybody. That helps us greatly as we continue to build our team brand. We're going to go ahead and review disclosures briefly and then move into the discussion today. So please, first and foremost, remember that our conversation is exclusively informational and educational. We do not make recommendations. We do not make endorsements for a specific approach to trading the market. We will be covering some option viewpoints today. It's important to remember that options are not appropriate or suitable for all investors. You do need to be approved on each individual account in which you might like to trade options in order to trade those here at Schwab. So we ask you to spend the requisite time to go through your steps, become approved. You can carry various levels of approval on each individual account if that is your preference. Additionally, as it relates to options, we encourage you to be familiar with the characteristics and risks of standardized options. You can always call us anytime to get a copy of that. We're available to you 24/7 every day of the year. It's also important to know as it relates to selling options here, everybody, because we work in a paper money version of our Thinkorswim desktop application, that when selling options in paper money, you will never be early assigned. However, in a real world situation, a real world trade, you absolutely, as the seller of options, are at risk for early assignment. Now, the level of that risk will vary depending on how deep in the money your contracts might be, or whether, for example, if you're selling calls, if the stock you're selling calls in undergoes an ex-dividend period, that'll increase likelihood of early assignment. However, the big walk away here today is that early assignment won't happen in the paper money version, but it absolutely can happen in real life. So you need to be aware of that. If there's questions or concerns about that, you can always call and have a conversation with a broker so you have a clarity on the mechanics of short option trading. All right, so there you go, everybody. There's our disclosures. We're going to get started right off the bat with a look at the S&P 500, which is a little different than it was when Brent and I got started this morning. We did have that gap open that had been green for us, turned a little bit red as we've moved lower this morning. If we take a look at it on a 5-minute bar, well, all we did here was fill that gap, everybody, at least to this point. So some traders would suggest if we can get off of this ledge that we've just created at 65.45, 65.46 or so, and start making our way back higher, we might have the making of a bounce zone for an intraday basis. Now, very much remains in doubt. We are below the 20-period EMA on a 5-minute bar, which can be a little bit of a heads up. As you noted yesterday, Tuesday, we got above that 20-period EMA, and we held it for the entirety of the day. Some days are like that, and you can monitor and manage against that 20-period exponential moving average that some traders might use. Meaning today, at where we reside, we are right back into it. Now, if we can get through it, close above it for a couple of 5-minute windows here, then we may have the chance to challenge that 64.66 and potentially the same high we made earlier this morning at about 64.80. So does give us something to keep an eye on here intraday. Most important level for short-term bulls, as you can see here, is that 65.45, because under it, we could see a 20-point slip down to that pivot point, yesterday's equilibrium. Now, obviously, given the nature of today's gap, we don't want to see us slip down to that ledge. Even if we did and bounced from there, that would be fine in the longer range of the trend. But if we're talking about speedy moves here, what we're looking to maintain from a bullish standpoint is this gap that was created with today's open from yesterday's close. Now, one final note is going to be about the Russell, only because we noted off the jump today, Russell was outperforming, and it has continued, everybody. This is kind of notable. As you can see, we have now traded up to the same ledge from which we retreated in January and early February. 23.15 to 23.20 gives us an approximation of potential resistance here, but ultimately, the bulls on the Russell side are clearly in charge at this point, as we have moved to highs we have not seen in more than about 6 months. So a positive development in the short term on the Russell, and a continuation of the early morning move as we're up about 1.5% here. So that's some fun stuff. Always nice to see from a bullish standpoint when small caps are providing leadership. As Brent noted during our conversation today, it really speaks to the potential of the R word, that lengthy recession word, not really making its way into headlines. And the further we get from seeing that term in headline risk, the better off the small caps are apt to perform. Of course, a falling 10-year note will continue to contribute to the small caps as well. So with that, everybody, one of the things that I've been hearing from some of you on is that we need to look for some more bearish scenarios and potential setups. And so I do have some opportunities for those today, and we're going to look at placing a couple of example trades in that space potentially. However, I wanted to start us off with a quick look at stocks making new 52-week highs. And, one of the things I noted here in this particular class today is, of course, that Barb's taking over again next week. So I'm not sure about necessarily starting a brand new trade. I think we can definitely put one on as an example for viewers, but it is going to be lacking in our ability for follow-up. So when we have that opportunity, we'll basically be looking to put us into a trade for an example that makes sense, and we'll do a bracketed scenario whereby we have upside exit strategy and downside protection exit strategy as well. And what I'm leaning into here, everybody, is known as a scan that I've titled the 52-week breakout within the S&P 500. So essentially, what I've done on my scan page is if you go into your available scans into public, we have stocks making new yearly highs. And that's what I've started with, was new yearly highs. But after that, I wanted to add in some additional components. And so I've defined the stock price range as in $10 to $50. Okay, so that gives us a tighter window of potential securities for consideration. We are also noting that these stocks are ones with adequate average volume over a 50-day period. So I put in a study to indicate average volume of 50 days greater than 500,000 shares. So should have no trouble in terms of liquidity. And then finally, in looking here at the Hang on a sec, everybody. I think I grabbed 10 to 50 down trending. I clearly grabbed the wrong one. My apologies. Bear with me 1 second here. 52-week high is what we're looking for. 52-week high breakout SPX. That's what I wanted. I'm sorry. So here, this is basically utilizing the new 52-week highs and applying it to the S&P 500. The two main studies that the platform is working with are a stochastic RSI and an ADX. And so the ADX is simply 3 bars ago is greater than the ADX from 2 bars ago. So you're basically looking at the initial move, if you will. This is not assigning any break point in terms of price in this case. So this is fairly standardized. The only difference is I have defined it with an intersection of the S&P 500. So again, very basic, available public scan that is intersected within the S&P 500. And we, of course, can exclude other groups if we wanted to keep some from being in the mix here. But what I noted was when I go to my chart and I've built that watch list in here. Oh, I know one other thing that I needed to point out, because I had some of you reach out to me directly to let me know about this. And I actually spoke with somebody this week in New York City about this. And I've been a little remiss in my education, everyone. So I'm bringing you a new note. A new tidbit. So listen up. We have a 52-week high scan that we've created. And when we load it here in our watch list, we can keep an eye and monitor the watch list so that we see when stocks get added or removed from the scan, meaning whenever they meet that criteria, they get added on. And when they are no longer meeting the criteria intraday, they fall off. Well, we can actually add, by left-clicking in the title here, we can add an alert when the scan results change. And this way, we can be notified if a symbol is added with a notification, like enabling here, let me know what you want to do. So here what I've done, just scroll down, as you can see, I can tell it to play the sound, can give it a bell or a ding or a chime, or you can obviously customize your own sounds here. But it's one thing to have a dynamic watch list, but it's another to be notified when the watch list changes, right? So you can be available to make an alteration. So this can also send push notifications to your mobile devices if you've gone through that setup process, of course, everybody, which I recommend doing. So just come to here. Again, I'll highlight that once more, how we do it. So you're left clicking on the title of your watch list. You're going to come down to alert when scan results change. And then you're going to tell the platform what you want to be offered. Do you want to notify with a specific sound? If so, which of those sounds, etc. So this can be a great way to be just mindful of what's happening with those dynamic watch lists, which will update very quickly, of course. So a nice opportunity here to limit some of our steps along the way. So I wanted to make sure I mentioned that. Big thanks to my viewers who have been reminding me of this and making certain that not only am I aware of it, but that I share it with all the rest of you who may very well benefit from using it. So let's take a look at our dynamic watch list from a 52-week high breakout. And I know that this is not ideal for every trader because not every trader is wanting and comfortable buying stocks that are at breakout levels or new 52-week highs. But 52 weeks or otherwise, new highs are not considered bearish. I know you've heard us say that all the time. We say it consistently. But as a reminder, one of the things that you can find are instances that are in the process of breaking. So one of those instances is a bit of a flat flag in here. We did bounce off of the bottom of the flat flag. Some traders would look at the line that we've exceeded with today's action as kind of being the validation of that breakout, having traded to that new high. And excuse me, with that in mind, some traders would go back and find when we began this flagpole. Now, This as a pattern is a fun conversation because flagpoles, bullish flags are traditionally continuation patterns. And the conversation around building the pole, deciding where to draw from, is a fun one, but also really specific to each of us individually. So let's drill in a little bit. While we notice that we've got, I'm going to go back to just before the low. We do have an uptrend that some traders would make note of. It's pretty consistent with the 50-day moving average, no shock there. And we've gone sideways for about two and a half, almost 3 weeks here since the earnings. Now, that's what I want to call out, is the earnings window here, because again, defining a breakout, or in this case, a flagpole, can be as simple as the trend or the action rather that led to that break. And you can see that you might say there's a bit of a flag right here off of this 20-day moving average test. It went up to about here, and then we went sideways for a little bit, right, with a very brief pullback towards and kind of in the vicinity of that 20-day moving average. And some traders would draw that flag to the peak we just broke based on that test of the 20-day moving average. And that might make sense for some traders. However, we could also suggest that the way to look at this is for using the earnings announcement, which was before market open on the 24th. So this is the 24th day, July 24. And here they might look at the closing value of the prior day, being that the earnings in advance of market this day might make sense to draw the line up to the peak we just created. And the reason being is that that was what led to this rally. Now, you can, of course, start from back here if you prefer and draw the line like this, right? Now, ultimately, they're going to be very similar, not too big a difference. This line suggests about a $24 potential move to the upside versus this line suggesting about a $13 move to the upside. Maybe a trader wants to use both of these lines. So they'll take the first one, activate it, and add it to the breakout spot, and that gives target 1. And then they'll take, or actually would give, in this case, because that's a larger distance, they would make that target 2, and then add this one to the breakout and make it target 1. So it'd be something kind of like this, right? So target 1 and target 2. Now, if you are a frequent attendee of either this class or many of the trader talks we discuss, this is a process that some traders will use because you don't know if that first target's going to even be met. And so some traders would say, all right, if I can get to the first one, great. I'm going to take off 25% of my trade. If I can get to the second one, I'll take off the remainder, or maybe just another 25%. Ultimately, it is each individual trader's opportunity to define that process for themselves. Very important to define it, to stick with it, stick to your plan, essentially, right? You guys have heard me say that many, many times. So with this in mind, everybody, looks like my high-low bubbles are kind of creating a little, there we go. That makes it a little easier to see. So we have the potential for a breakout trade opportunity, an example trade that'll allow us to target 180 and possibly 190, 191. Okay, so let's look at this and let's talk about building in an equity trade, okay, long stock based on an uptrend working, holding a 20-day moving average, and potentially giving us a chance to start a big trade here that we will piece out of if we can achieve the various upper levels, okay? So for many of you, you might suggest that with the break today, you may not want to stay in the position if it falls back into this range we have now traded in here, right? If it gets right back into this 163 to 167 area, they may not want to stick with it. By the same token, They might say, you know what, I understand a breakout was tried, it didn't happen. We would, maybe a trader wants to stay with it as long as the 20-day moving average holds. Well, given the opportunity to be a buyer at 168 and maybe a seller at 180, that'd be about a $12 upside. We could possibly afford to risk down to the 20-day moving average under 162, risking 6 approximately to make 12 approximately or more. Because if we run that to 190, obviously we've got a bigger profit scenario. This can work out whether the trader wants a very tight risk strategy, maybe under today's lows, or wants to incorporate the 20-day moving average, probably by some measure beneath it, right? Whether it be a flat percentage, or maybe they want to incorporate the low in the move since it has moved to the upside post earnings. And that low that day was 161.72. So I might just take my line and just draw it like this and say that the exit needs to be under that 161.70 area. Okay, so I hope that I've explained that in a manner that might make sense to a multitude of traders. Once more, it is the job of the individual trader to discern where it matters most for them. Is it the idea you don't want to get thrown back into range, or is it more important to monitor that orange 20-day moving average? For a lot of traders, it might be the latter, the 20-day moving average, given that we've maintained it for as long as we have. Dating back here, I guess we go back to about June, so about 2 months almost here above the 20-day. So let's use the 20-day. We'll use our 161.70 approximately. Under that, we're going to go beneath it by a decent percentage, a couple, maybe at least a quarter or something like that. So let's look at our potential here for a long equity trade, and then we'll move on to some bearish scenarios. So we're going to do a buy custom with an OCO bracket. And I'm going to get a little tricky here because as I make my adjustments, I am going to incorporate an initial sale, but not a second sale. So here's the way I'm going to build this. We're going to consider buying 100 shares. We will do a market order, not guaranteeing a price in any way, but it's going to give us an opportunity to get into the trade right away. Then we're going to place a limit sale that is good till canceled at the first level. We're going to call that 181. But we're only going to do that for 25 of our shares, okay? And then we're going to go with a stop exit for the entirety of the position under the 20-day moving average, which we said is just shy of 162. So if I put this in at 161, maybe something like 161 and picking on some non-round figures, maybe 161.63. So that'll definitely be below my white line. And again, that's me trying to work to mitigate my downside risk. If we're buyers immediately at 168.49 and my stop at 161.63, we're risking about 7 points in this scenario. Now, the reminder I have to offer, once more, stop does not guarantee our price. So while we can trigger at 161.63 in a gap scenario, we could open below 161.63 and trigger, for example, at any price under that. So if it gapped lower, we opened at 150, we'd have a trigger and in a market order to sell immediately. And that could mean we execute at a price well lower than 161. If we opened at 150 to trigger, odds are very strong we're going to come close to 150 for our execution there, okay? So please keep that in mind. But again, what I like about this trade from an example standpoint is that we can enter a full trade, do an exit strategy for a portion of it if it makes it to our first target, but also maintain an exit strategy beneath us for us to maintain our risk as it's associated with the entirety of the position. Now, make sure along the way, if we get executed on that 25, we got to make an adjustment to our stop order because, yeah, we will be selling some, but it's imperative that in order to take profits on a portion, we have to make sure that we don't give back those profits by allowing the remaining shares we hold to drop. So we have to then raise our stop order to a more appropriate level thereafter. Okay. So to answer some questions, yes, this is a buy custom with OCO order. One cancels other. Now, the adjustment that you might need to make here, everybody, is with this little icon in the quantity field. If you have that icon pressed, you will note that it doesn't allow you to make an alteration to your exit numbers. So you want to make sure that it reads this and says, okay, you're buying 100. How many of the 100 do you want to sell at your limit? I told it I want to sell 25 if I get to my limit. You know what? Let's just make it 50 for ease. We're going to do half of it if we get to our limit. But if it falls to our stop first, we're going to get taken out of the entirety of the trade. Okay? So I hope that that helps out everybody. Again, the concept being mitigation of risk and multi-targeted levels above. So I'm going to go ahead and confirm and send this as an example trade. And we are in the position right off. So we've got one for us there. So there's an example of a one cancels other order in a possible breakout, and the look of targets built by a potential measured move, considering a bit of a bull flat scenario that my friend Cameron May likes to call these flags when they get a little sideways like that instead of more like a pennant, that shows the lower highs, lower lows. This is simply a more flat flag scenario, or a flag in a stiff wind, as you might say. Okay, let's take a look at some bearish situations that I've got developing here, utilizing a downtrending scan. So downtrending was a grouping that I built originally. This is what I was talking about originally, and I apologize again for messing that up. But we're going to go ahead and launch my personal downtrending $10 to $50 scan. And again, this is pretty simple, everybody. And I want to remind you all that it is fairly simple. We don't have to get cute. We can stay very basic and still maintain a proper process. And I think that that's what this illustrates. So what we're looking for are stocks that are 10 to 50 a share in the S&P that are in the midst of a downtrend. These are stocks, so we have a stock close price between 10 and 50, average volume of the 50-day window at greater than 500,000 shares. So again, liquidity placing into the being a big part of this. And then lastly, our custom study is that the last trade or close is less than the 20-day simple moving average. And I'm going to bring this over so I can highlight. I've got two criteria here. So the last close is the 20-day simple move is below the 20, but also below the 50. Okay, so that means you are seeing stocks likely in the midst of a downtrend, trading below 2 of the shorter term moving averages. All right, so that's what we did here. And I actually found a few that are notable. The very common pattern you'll note here is going to be something we see in Baxter. And so I'm going to bring Baxter up. So what are we seeing here, everybody? And you've heard me say this before. The truth of the matter is we don't really need to necessarily know if the pattern is a flag or a triangle or a pennant. The truth is, what we need to pay attention to are the levels that will matter in such a pattern. And very commonly, those levels are initially a gap level here. And reminder, we spoke about this to the upside a moment ago. What was it that led to that original move? Well, here in Baxter, we had an earnings report before market open on the 31st of July. On the 30th of July, we were up here around the 20-day moving average, admittedly struggling. In fact, even though we hadn't had earnings, clearly the bullish and bearish traders were waiting on the earnings report for some semblance of validation, right? Because we had been below this horizontal support at around 29, traded down to 27 and change, and rallied into the 20-day moving average before we started to lose steam. Well, the losing of steam is one thing, but the big move here occurred after the earnings announcement, as you can see, everybody. So if we take a move from the failure level and draw it down to our post earnings low, we now have the new bear flag hole. So if this is the case, we have an uptrend very quick, right? But take a look at raw volume down below. What stands out here, everybody? I would think you're seeing the same thing that I am seeing, right? Declining volume into the selling initially, but also a rally of about, well, let's see here, $2 and $2.50. So we've had a 10% plus rally that has been happening on lighter and lighter and lighter volume as we move into a potential zone of resistance. Okay. Not necessarily ideal for the bulls. Not to mention, it's also in the midst of a downtrend. So bulls who want to be buying here are counter trend to the long range, right? We clearly have a downtrend in place. We're well below the 200, well below the 50, still below the 20. The 20 isn't even, we're not even getting price action caught up to the 20-day moving average. So some traders will look at this as a potential scenario. Now, Paul makes a great point. He's not sure that the gap should be considered as part of the flagpole. And Paul, you could be absolutely right. My job is to remind you that we are all different traders and the scenarios can play out differently. So somebody might use the flagpole we've created and look for a target at the failure zone, right at the gap, right? And then some others would say, you know what, I'm only going to build a pole from here to here, from the open to the low. And that could work, but that's going to be a much lower scenario, right? So it does require some patience, and it requires us traders to, of course, plan these things out. Know what familiarity you have with this type of a maneuver and give consideration to it. It might not be that you really think it has any chance to get all the way down to 16, but you might think it has every chance to at least retest the lows we have seen at 21. Okay, so that's a lot of talking from me simply to give you a few concepts for consideration. But let's clean all this up and let's build a bearish strategy for an example trade, incorporating an option setup here, everybody. So we're going to make note of the fact that we got into the gap today over 24.25 and have at least to this point failed. Now, some of you will feel better with failure after a test at the 20, but there's no guarantee we get there, right? So somebody might feel like, hey, this is okay to start this trade, maybe look forward, not necessarily to this week, but it could be next week, it could be the week after. And the consideration might be, if they think that the gap level is going to present as resistance, well, then they might go with a strike price slightly higher than where we are. So that might be, a 25 strike, for example, whereas the trader who wants to make sure that we don't trade above the 20-day might look at a strike price around 26, because the 20-day right now is around 25.5 or so. Okay. So yes, Paul, long put vertical was what I was thinking of as our example here. So we can consider a $25 strike for the long put, and maybe the short side of that spread, a 21, possibly a 20. But I have a feeling that the 20 is not going to give us a whole lot to work with in terms of access or excuse me, in terms of a bid. So let's take a look. We're going to have to do this, obviously. Take a peek at the strike prices and let's see what we can work with. So we're going to ignore this week. We can give consideration to next week, and we might find this to be kind of affordable because our price per contract is not substantial. Now, at 25 strike, everybody, notice that delta is pretty high, almost 80 cents. So let's remind ourselves of what delta is. Delta is the is the ratio of $1 move in the underlying stock that results in the move of the option. So at 79 cents, the suggestion is that the $25 put will go up by about 79 cents with a $1 drop in the stock. Or if the stock were to rally $1, you would lose 79 cents in the long put option, right? So that also suggests a potential of about 80% likelihood that this contract is in the money on expiration Friday. But I got to remind you, expiration Friday and in the money happens at $24.99. So that doesn't mean you're going to have value remaining necessarily. Okay. But that's the way that a trader might look at that. So starting with a $25 strike price on the long put and being willing to take it down to maybe a 23 to create a $2 spread. The only trouble here, everybody, is you're really not saving a lot by selling the 23 because that is a bit away, 10% away. The question is really, can a trader validate putting on that level, or do they want to go with a tighter window that could result in maybe a more likely trade playing out in their favor, maybe a $1 spread. If we did it at a $1 spread, so instead of selling the 23, we sell the 24, it's going to cost us only 68 cents or $70 on the trade, so make it 70 right there. But because it's a $1 spread, we can only make the difference between our cost and the spread. So if we pay 70 cents, we can only profit by a max of 30 cents. So that might not necessarily make a lot of sense. This might be one of those deals where we have to go to the August 29 window and see if this could be a little bit more opportunity for profit if we're leaning that bearish direction. So what about if we did it here? You can also make the change up here, but I'm going to go ahead as an illustration of how to do it down below. We're just going to change the dates here to August 29. There, they both changed. And now we're at 25 by 24. And our natural is 80 cents. So maybe now if we go to the 23 and see that the cost is $1.20, well, now we could be looking at a $2 spread, cost us $1.20 to make 80 cents, or $120 of outlay to make $80 in profit. Still not ideal necessarily for some of you. You might want a greater move or a greater amount of profit. But I hope the takeaway is to consider utilizing many different option strike ranges, either strike price ranges or series with differing dates, right? Because you can put yourself in to a scenario that just makes more sense for you as the trader than maybe what is offered in only a 1 week window or a 2 week window. If you want to go a little further out, give consideration to that. And in the sense, and the standpoint of using Baxter, having just undergone earnings, you can go out 8 to 10 weeks and not incorporate the next earnings window in all likelihood. So while we always remind you to be aware of that earnings window, on one that has just announced, you may not have nearly as much concern there. Okay, so that's what we're gonna go ahead and do. We're gonna lean in to this 2 week scenario. And for our example purposes, I like the idea of the $2 wide spread. And let's see if we can get in a little cheaper. And we'll go down to about 110. So spend 110 to make 90 and go from there. Yes, I'm so glad you mentioned this, Salient Joe. Thank you. Another idea is to wait for confirmation, enter the trade once the price moves below the high of the day. So that's an interesting view. I'll remind you all, excuse me, as we drill in here, if we think that this is the highest trade in the scenario or in the bounce back, well, if today made the highest high since the sell-off, well, then all we need to validate for some traders that want to be bearish thereafter is you got to trade through today's low tomorrow. Ideally, it would be a close below the low of today tomorrow. That would be a close below the low of the high day, suggesting that the rally window following that big gap lower is over. We might very well be getting started early here, Joe. You're entirely correct. I'm glad you mentioned that. So let's go back and we'll place the trade to make sure that we've got this one in. So again, we are buying a long vertical put spread, long the 25, short the 23, max gain of $90 for max loss of 110, all of which assumes we are not in some way exercised to a share position in Baxter. So that's just assuming we close the option out prior to expiration. All right, so we'll send that off. And we've got about 5 minutes to go. And I promised you all that we would look at our trades from the prior class. And so that's what we're going to do here. We put on two. One of them was in Southern. It was a long call spread in Southern, buying the 92s, selling the 98s. We had a lovely trade fall apart actually on us. We're going to look at it real quick. This was expecting a breakout. We got put into the position after we got rid of, or after we got out of class last week, and then the stock pulled back. So here with our expiration for next week, this still has an opportunity to be profitable. So there's not a lot to do here, of course. You know, we put ourselves in the trade. We spent about $320 to do it, but by no means do we need to make an alteration now. Taking off the trade doesn't make sense necessarily, especially since it seems like we might be getting a bit of a bounce off of what some might say is support. If my original support line were redrawn, for example, it could look a little more optimistic. If we take a look at the other one we did, which was a Fastenal equity trade, we got long the stock. So here we bought a week ago on this breakout move. So right here on the 6th, we had the stock breaking that flag portion, validating the idea that you could believe that the uptrend working against the 20-day was set to resume. And sure enough, not only did it was the bounce in place, but it did resume and did move us to new highs. And so now we've got an opportunity to consider an exit. And a lot of traders would consider taking some profit here, perhaps, or putting in a stop order beneath that 20-day moving average. The 20-day moving average would be appropriate, but also could leave us with maybe a worst case scenario of a break-even trade. So we're up a little more today. Our entry is at 46.62, and we're up a couple of bucks. And look at where the 20-day is, 46.89. So, you know, maybe the trader wants to use a stop order that's really close to their 46.62 entrance, which means you've got a really solid chance of, in a worst case scenario, perhaps exiting for a break even. I'll tell you what, if you can get comfortable exiting for break even on weakness, a lot of traders would be happy with that. If you're not giving profits up, it's one thing, but if you're not taking losses, that's a whole other scenario. Obviously, we don't want to turn a winning trade into a losing trade necessarily, but it would be appropriate nonetheless if it took out the 20-day with any conviction. Many traders from this trend might choose to move on. So we're going to let that one go. It's in the midst of an uptrend. It's making new highs. Not a whole lot of reason necessarily to get defensive in nature. But like I said, traders might take a little bit off, might add a stop order down below as a protection, or might just simply choose to let things run. But, you know, one final note that I've mentioned within Trader Talk this morning is in regard to complacency in the market. And, you know, if you're feeling as though nothing can go wrong, maybe you've been really consistent in your trades, you've been solidly profitable. The reminder I have to give you is that when we're feeling really smart can be a good time to start to get a little bit defensive, not necessarily to take profits, but to at least consider the possibility that what's been working won't continue to work in perpetuity, because we know nothing works in perpetuity. So please keep that in mind. All right, we're going to go ahead and wrap there, everybody. I want to thank you for being here. Thanks for joining. And certainly thanks for humoring me for the last 6 weeks or so as I've picked up this course for our friend Barb, who returns next week. I see we have a survey opportunity in the chat. I would always value your feedback, everybody. It's really helpful for me as a coach. So if you take the 2 minutes to give a score, and if you have any comments, I'd love to read those. Those come directly to us as hosts, so that's very helpful. Hit that thumbs up button below if you like the conversation as well. And don't forget to make sure you're subscribed to the YouTube channel and follow Brent and me on X, Brent Moores CS and Kevin Horner CS. I want to thank you again for being here and participating in the segment. I look forward to seeing those of you in Chicago this weekend. Always wonderful when I get a chance to shake some hands. I know I saw a bunch of you in New York, which was excellent for me. I hope excellent for you as well. But thanks for being here. Have a fantastic rest of your Wednesday. I'll see you again real soon.